So now we're going to issue some stock for non-cash assets. So let's think about non-cash assets. It's something other than cash. So when we issue something for non-cash assets, we're not going to be debiting cash, okay? In this case, it says we're issuing 25,000 shares of $2 par common stock for a patent. So we're going to be debiting patent because that's what we're getting, and then we'll be, doing our usual, how did we get the patent? Well, we issued some common stock to get it, and we're going to have some paid in capital in excess of, and this is a par value stock, okay, on common stock. This is okay on my exams. You have to tell me it's paid in capital, in excess of par, or stated value, and you've got to say it's common stock, because later we'll get to preferred stock. Okay, so let's talk a little bit about these non-cash assets. In this one, it says that we don't know the value of the patent, but the stock is actively traded at $5 a share. What are we trying to accomplish here? We have to come up with a legitimate value for this asset that we're bringing on. If you've bought something, if you've issued the stock for cash, you've got a value. You've got so much cash, that's what you've got, that's okay. But we don't really know the value of this patent. It says the value is unknown, and so we have to come up with what's called the cash equivalent price. So the cash equivalent price, there's a definition given in the notes, but basically it's kind of self-explanatory. You're trying to get to what it would have been if it had been a cash transaction. Okay, so if the stock is actively traded, that gives you a very good indication of that. So let's see what happens here. We issued 25,000 shares, okay, at $5 a share, actively traded, so that's a valid price. So we can bring this patent legitimately on the books at $125,000 because the stock is actively traded. How much can we attribute to common stock? That's the same as when we issue for cash. It's going to be the 25,000 shares times the $2 par, or 50,000, and then the balance is going to be the paid-in capital over and above, in excess of par value. Okay, so what things other than patents could we have here? It could be you buying stock, you're issuing stock to get equipment, you're issuing it for legal services, and a lot of times this happens when a company is just starting up because a company hasn't maybe had many sales yet, it's not having revenue coming in. It needs legal work done, the whole corporation setup, and sometimes the attorney will accept shares of stock instead of cash. So that would be one instance, for professional fees, you could do it that way. A lot of times, companies will issue stock at the startup to get the equipment they need to run the business. Okay, so that's what we're talking about when we're talking about non-cash assets. Okay, so now what else could happen here? Here the stock was actively traded, so we know how to do that. But what if it's the same situation except the stock is not actively traded? It could be a closely held corporation. Maybe you've just got a few stockholders and it's not traded on any stock market. Then how do we come up with a proper value for the patent? Well, we can't use the stock value, but we have a value of a similar patent that's $90,000. So we would be able to justify bringing the patent on. In this case, if we've got a comparable value for a similar patent, it would come on at $90,000. Okay, and then we would do, our common stock. We issued the same number of shares. We issued the, 25,000 shares at, $2 par. So it's that would be come out at 50,000. Okay, where the stock is not actively traded. This would be in excess of par. We're only going to have additional paid-in capital of the difference between the value of the patent and the par value of the common stock. Okay, so that's where you're issuing stock for non-cash assets. So there's a few examples that I give in the notes after this that may add a little additional explanation to it. And then if you need more explanation, just let me know.